Good morning, everyone. Am I audible? Right. Thank you. Good morning and welcome to session 5. So, out of the 6 weeks short course, we have come to fifth day as well, session 5, and we have only one more week to complete the short course. So, today we are going to talk about two topics. So, if you have gone through the course outline we have shared with you, we are going to cover two topics, CVP analysis and then the pricing. And then we don't have any guest lectures today, and I'll be taking the full session. And then we'll finish part one, that is CVP analysis, and then we'll move to part two, pricing. So that is the plan for the day. Right. So, do you have any issues from the content we discussed up to now? Any clarifications you need to make? Right. If you have any issues, if you have any clarifications, you can discuss. Right. Okay. So, session 5, part 1 is all about cost, volume, profit analysis. Can you please state in the chat box if you have not learned this concept before? Anyone? Previously, you have not learned this concept before? Break-even points, contributions, those concepts. Anyone who has not learned? Now there are only 11 students anyway. So yeah, so I hope you have learned this before, right? You have learned. So we'll see. We'll refresh our memory on fundamentals, okay? And then identify the true meaning of this CVP. So these are the learning outcomes. I'm not going to go through. So I'm straightforward. I'm going to what is CVP analysis? What is CVP analysis? Now, as the name suggests itself, CVP analysis means relationship between C means cost, C, V, and then P, right? These are cost, volume, profit analysis. It's like this. When the volume, especially when the volume increases or decreases, when the volume increases or decreases, volume means maybe sales volume. What is the impact on the cost? Or what is the impact on the profit? When the volume decreases, what's the impact on the cost? What's the impact on the profit? And also, when the cost is increasing, or decreasing, let's say, what's the impact on the volume we are going to sell? What's the impact on the profit? Right? When the cost changes, the impact on volume, impact on profit. This is how we are going to, these are the relationships we are going to talk about coming under CVP analysis. So it's a relationship. So CVP analysis is a technique used to examine the relationships among cost, volume, profit within a relevant range. That is very important. Now, we are going to talk about so many assumptions, some techniques, some formulas coming under CVP analysis, but very important, within the relevant range. All these relationships can be discussed, but within a relevant range. Within a relevant range. That means these CVP analysis techniques, we are going to discuss within a short run. What do you mean by a short run? What do you mean by short run? Yes. What do you mean by short run? What's the time period covered within short run? What do you mean by short run? Are you guys still sleeping? Or is it very boring? You have learned this before? What do you mean by short run? More than 12 months or less than 12 months? Less than 12 months. Less than 12 months, right? Short run basically. Long run means more than 12 months, 12 or 12 more than 12. Short run means less than 12 months. Within 1 year, less than 1 year. So, in this CVP analysis, in these techniques, these relationships are discussed within a short run. Short run means less than 12 months, less than a year. Why? Because if we take short run and the long run, if we take short run and long run, there are so many differences between these two. If we take short run, tell me what is the tendency of changing a selling price of our product? What is the tendency of changing the selling price of a product? Is it very high or is it very low? Tendency of changing selling price of our product. Within a short run, tendency is very high or very low. I would say low, right? And then what is the possibility? What is the tendency of changing our operating capacity of the factory within the long run, within the short run? Within the short run, what is the tendency of changing or expanding our operating capacity? Low or high? Low or high? I would say high. Within a very short period, within 1 year, there's a tendency of changing the operating capacity, so it will be a long run decision making. I would say the tendency is lower because it's a long run decision to put up a new factory, to come up with new machines and all, long run. But within a very short period, those things will be fixed. I don't say it will not change forever, but tendency is lower. Tendency is lower. Probability is lower. Changing the operating capacity, right? Changing the selling price and everything. So likewise, short run, most of the things are fixed. Most of the things are fixed and constant. Most of the things are fixed and constant. There won't be much differences in the business, short run. But if we take long run, if we take our business in the next 5 years, operating capacities might have changed. Our selling prices would be different. Our cost per unit, maybe material cost per unit, those things would be changed after 5 years. In the long run, after at least even after 1 year, in the long run, there's a high tendency the things will change because in that period, there can be so many changes happening in the environment. There are so many changes happening in the business. So with that, our operating capacity, selling prices, cost structures will change. So in that case, short run and long run are different. That's the main difference, right? Most of the things are fixed in the short run, but most of the things are not fixed. That is variable coming under long run. Now, if we take CVP analysis is a short run decision making tool. That means, can we use CVP analysis as a long run decision making tool? Can you use CVP analysis? Can you identify these relationships in a long run using CVP? No. CVP is used in the short run. Remember, that is very important. It's a now you can learn CVP analysis from textbooks or anything, but if you don't know how to apply CVP in your business, whether it is a long run decision making tool or a short run, that is very important. So short run decision making tool. Now, what about the relevant range? What about the range in the short run? Short run, we can identify the range. Okay, short run, during 1 year's time, our sales volume would be this. we know with the expectations, with the budgeted figures, with the past information, we can have our relevant range. We will be producing and we will be having a capacity of 2000 units in our factory. That is the relevant range. 0 to 2000. We know that because with the machines we have, because with the factory capacities we have, because with the labor requirement, labor hours we have, in the short run, we have a relevant range. In the short run, we have a relevant range. But that range would be different from the second year onwards, maybe, because we are putting up a new factory. That range would be different in the third year because we are having so many new machines. We have so many other labor types coming to the factory. Likewise. So the relevant range is there in the short run, and CVP is a short run decision making tool. So those are the things you need to remember before we start. So cost, volume, profit, and the relevant range are very important in the CVP analysis. Right. Now, before we learn the techniques in CVP analysis, there are fundamental assumptions. There are fundamental assumptions. I will tell you why these assumptions are there, but we'll read the first assumption. First assumption is all cost can be classified into fixed and variable elements. All cost, if we take rent, if we take direct material cost, if we take cleaning staff salaries, if we take electricity, everything we can classify into fixed and variable elements. Now, if you can remember, what are the 4 types of cost we discussed as per the cost behavior in the second lesson, in the second week? What are the 4 types of cost we learned based on the cost behavior? One is fixed cost. That is obvious. The second one is variable cost. What are the other cost types, if you can remember? What are the other cost types? We identified 4 cost types based on the cost behavior. I told you sometimes fixed and variable, both components they are. Yes, semi-fixed, semi-variable cost, I told you it as mixed cost. Both fixed and variable components are there. When the production is 0, still you have a fixed cost. And when the production is increasing, your cost is also increasing. Or sometimes up to some point, fixed cost is fixed. And when you exceed that range, when you exceed that level, cost is increasing. So mixed cost. What's the other one? What's the other type we discussed? Step fixed cost. Can we remember? Step fixed cost. It will be fixed for a certain range, and then suddenly cost is increasing, and then again fixed for a certain range, again increasing, like as a step fixed cost. So there are different types of cost, but when you learn CVP analysis, we assume that all cost can be classified into fixed and variable components, right? That is the first assumption. Second assumption, total fixed cost will remain constant at a given capacity. That is obviously true. Total fixed cost will not change, but at a given capacity. Fixed cost can vary or not. Can there be changes to the fixed cost? What do you think? Fixed cost is fixed forever or it can change? Yes, it can vary, right? Fixed cost can change because fixed cost is constant at a given capacity, at a given range. After some time, it can change because step fixed cost, up to some point, cost is fixed. But after some point, cost is increasing and then again fixed. So given a range at a given capacity, fixed cost will remain constant. So that is the second assumption we have. Actually, even though it's an assumption, it's very true, right? Fixed cost is not fixed forever. It will definitely change, but it will be fixed for a certain period or certain capacity. And now in the short run, what do you think? In the short run, with the assumptions we have, we assume in the short run, fixed cost will be fixed, right? That's how we usually assume. In the short run, we assume that the operating capacity won't change, the technology won't change, efficiency level would be the same because it's a very short period. So the fixed cost would be same. Fixed cost would be the same. It remain constant. The third one, the variable cost varies proportionately with changes in volume. Isn't that true? That is also true because when the volume increases, variable cost increases. When the volume decreases, variable cost decreases. So we assume variable cost varies proportionately with the volume. That is the third assumption we make. Next one. Selling price, variable cost per unit, total fixed cost are all known and constant. So look at this selling price. Selling price is known. Selling price is very clear and we know organization knows the selling price. And then it is constant. Selling price doesn't change. So will there be price revisions in the short run? We assume no. No, there will be no any price revisions. Selling price would be fixed and it is same for the whole short run period. So that is the other assumption. Variable cost per unit. Variable cost per unit. What are the components coming under variable cost per unit? What are the cost components coming under variable cost per unit? What do you think? Variable cost per unit. What are the cost components coming under that? What about direct material cost? Yes, direct material cost per unit, direct labor cost per unit, and then direct other cost per unit, variable overhead cost per unit. All these are variable cost per unit. So direct material cost per unit, let's say to produce 1 unit, we need 2 kilograms of this particular material. So 2 kilograms of one material, that 1 kilogram of that material is 200 rupees. So if 1 kilogram is 200 rupees, if we need 2 kilograms, that means 400 rupees, right? 400 rupees per unit. It doesn't change over the short run. We assume that it is fixed. It doesn't change. Why? We assume in the short run, things are constant. Things doesn't change. So we assume that the variable cost per unit is fixed. So we expect that labor cost won't change, hourly rate won't change, price per kilogram won't change. Those are fixed. So that is the assumption. Variable cost per unit would be the same. Total fixed cost, it will not change. Total fixed cost would be the same. Now, if we take, we have a factory, we have to pay the factory rent, that would be fixed in the short run. During the 12 months period, there won't be any changes to the factory rent. But after 1 year, after 2 years, in 3 years, 5 years, 6 years, obviously rent would be changed. Rent would be different. So in the long run, there would be changes. But in the short run, we assume that the rent is fixed, right? Total fixed cost is fixed, constant, and we know the cost. Next one. Over the activity range being considered, cost and revenue behave in a linear fashion. There's a linear relationships. There are no curvy relationships. In practical world, there can be curvy relationships. When the cost is increasing, after some point, it would be constant, or the pace at which the cost is increasing, there can be differences, right? With the economies of scale, everything. But in CVP analysis, we assume all these relationships, the cost line, variable cost line, fixed cost line, all these are linear as a single line. So that is another one, right? Given range, within the given range, all these are linear lines. We have so many assumptions. The only factor affecting cost and revenue is volume. What do you think about it? That means changes in production and changes in sales volume. That says only factor affecting the cost changes, revenue changes, is the volume. Do you agree with me? Now, it's true that it is an assumption. Do you agree with that point? What are the factors that will affect revenue of a company? Is it only the volume? What are the factors that will have an effect on the revenue of a company? Volume, that means the sales quantity. Is it only the sales quantity, or can there be any other factors? What do you think? Revenue? That means here the assumption is when the sales quantity is increasing, revenue is increasing. When the sales quantity is decreasing, revenue is decreasing. What is the other major factor affecting revenue? Is it only the sales quantity?
The
Other main factor?
market prices, the wages, the raw material costs, all.
Prices.
Yeah.
Price is the main other component. There can be so many other factors. But obviously, when the price is increasing, revenue will increase, definitely. So the ratio would be different, because when the price is increasing with the price elasticity and all, revenue would not increase by 100% if we increase the price by 100%. But price would definitely affect the revenue. So price and sales quantity both. What about cost? When the sales volume is increasing or the production volume is increasing, cost will increasing. That is obvious. But as the assumption it says, volume is the only factor affecting the cost. What are the other factors that might have an effect on the cost? To increase the cost or to decrease the cost, what are the other things? Is it only the volume? What about the prices? Let's say direct material cost. Direct material cost will increase when the number of kilograms we use from that material increases. If we use 100 kilograms, cost would be this much. But if we use 200 kilograms, cost will increase. Obvious, that is true. When the volume increases, cost increases. But what about the cost per kilogram? If the cost per kilogram is also increasing, cost will increasing. So the price of that material will have an impact, right? What about the technology we use? If we use high technology in the production facility, even though there would be a initial high cost for the technology, what about the unit cost? With the wastage reductions, with the increased efficiency and all, cost will decrease when the technology is there. If we increase our efficiency, let's say previously we had untrained labor in the production flow. Now we are using trained labor, skilled labor. So in that case, efficiency is increasing, cost will be somewhat reduced because the wastages would not be there, inefficiencies would not be there. So in that case, there are so many factors affecting the cost, not only the volume. Revenue side also, in addition to volume, there will be prices affecting revenue and other factors, competition and everything. So assumption is the only factor affecting cost and revenue is volume. So it's kind of a very limitation, right? This assumption becomes a limitation of CVP analysis. Okay. So what is the reason for that? Now, if this assumption is a very bad limitation of CVP analysis, why are we using this assumption? It says revenue will increase or decrease only because of volume. Cost will increase or decrease only because of volume. What is the reason? Why are we using this assumption in the short run? Because we assume, we know in the short run, there won't be price changes. There won't be price changes because this assumption is valid only for the short run. This assumption will not be valid in the long run. So given a particular period, given a particular range, sales prices would not be changed. So in that case, revenue will increase or decrease because of the volume. In the short run, technology won't change. We discussed that aspect, right? Technology won't change in the short run. It will definitely change in the long run. So, if there are no changes in efficiencies, if there are no changes in technology within the short run, the main factor will be the volume affecting the cost. If the prices of the materials are also not changing, volume would be the a factor affecting cost. So this assumption is valid in the short run. That's why we are using this assumption as an assumption for CVP analysis. So always remember we are talking about a short run. Very small, very short period, 12 months period. Next one. The technology, production methods, and efficiency remain unchanged. So as we discussed, technology doesn't change in the short run. Production methods, the tendency of change in the production methods, let's say labor intensive to capital intensive. Labor intensive means we are using more laborers in the production flow. Capital intensive means we are using more robotics, machines in the production flow. So the tendency of change in the production method would be very less. Efficiency would be the same because it's a short run. That is, those things remain unchanged, right? And then the time value of money is ignored. Time value of money will not be considered in the short run decision making. And then there are no changes to stock levels. That means the number of units you produce would be sold. Number of units produced equal to number of units sold. That is one assumption. Actually, that can be changed in the short run as well, no? But we can't exactly say that. But in the CVP analysis, but we identify that assumption, number of production units would be equal to number of selling quantity. So those are the main assumptions in CVP analysis. We identified many assumptions, I would say. So all these assumptions are limitations of CVP analysis. All these assumptions are limitations of CVP analysis. Then why are we using this CVP analysis? Why are we learning this? If there are so many issues like this, if there are so many limitations, why are we learning? Because all these assumptions, most of these assumptions are okay or are fine in the short run. Most of these assumptions are true in the short run in many business organizations. And even though there are some changes, even though there are assumptions are there, in order to get initial decisions, CVP analysis is very important. In order to have a broad understanding about your business, that is, yes, simple and understandable. In order to have those initial decisions, CVP is very important. So that's why even though we have so many assumptions like this, most of them are true in the short run. Still, we identify CVP as a very good technique because that is very easy and very important, very understandable, very simple formulas. We can easily get the very important numbers we want in order to make decisions. So we'll see how it goes. Those are the assumptions. Those are the limitations of CVP analysis. Right. Now I hope you can see this graph. We say linear relationships between cost, volume, and profit, right? CVP graph. Look at this CVP graph. What is this blue color line? Blue color line is the total revenue line. Total revenue line. Is that clear? Starting with zero. Starting with zero. That means when you sell 0 units, revenue would be 0. When you sell X number of units, revenue would be this much. When you sell Y number of units, revenue would be this much, right? Revenue is increasing. What about this pink color line? What about this pink color line? That is the fixed cost. Fixed cost doesn't change. Even though the production is 0, still we have a fixed cost and it is constant over the period. Because we are talking about the short run, it is constant. But in the long run, sometimes there will be step fixed cost like this. Cost will increase. But in the short run, it is fixed and we know the cost and it is constant. What about this one? This orange color line, I would say. Orange color line. It is a total cost. How can we calculate the total cost? When the production is zero, what would be the cost? Do we have variable cost when the production is zero? When the production is zero, do we have variable cost coming? What is your answer? When the production is zero, no variable cost, but we have fixed cost. When the production is zero, we have the fixed cost. So it starts from here, and then when the production is increasing, cost is increasing because the variable cost is increasing. Now, how can we show the variable cost from this graph? How can we show the variable cost from this graph? Difference between which lines? Difference between which lines? The variable cost. Difference between this total cost line, difference between this total cost line and the fixed cost line. Total cost includes variable cost and fixed cost both. So that is why it is increasing in that case. But if we take fixed cost, it is constant. So if we take give me a second. This area would be variable cost. This area would be variable cost. Why? This is fixed cost. This is total cost. The difference is the variable cost. Right. Now, look at the point. Look at this point. I will name the point as B. B point. What about the B point? What are the observations you have when it comes to the point B? What are your observations on point B? What are your observations? What do you identify? What do you see in point B? Exactly. When it comes to point B, right? When it comes to point B, this is blue color line is total revenue, and then this orange color line is total cost. When at the point B, total revenue equals total cost. TR equals TC. Total revenue equals total cost. Now say, when the total revenue is equal to total cost, do we have profits? Do we have profits? When the total cost is equal to total revenue? No profits. Do we have losses? Do we have losses? When the total revenue equals to total cost? No losses. So, point B is no profits, no losses. When the total revenue equals total cost, no profits, no losses. What do you call that point? When your business organization doesn't have profits, no losses, what do you call that point? You call that break-even point. Break-even point. The point where you don't have any profits or losses when the total revenue equals total cost. So, how can we identify this quantity? If I mention this as Z, how do you define Z? How do you define Z? How do you interpret Z? Z is a sales quantity, isn't it? Sales quantity is Z. How do you interpret Z? How do you interpret Z? How do you interpret Z? I have drawn that line from point B down the line. How do you interpret Z? Z means, yes, break-even quantity. How do you interpret that? How many units we need to sell to be at the break-even point? How many units we need to sell to be at the break-even point? That means in order to achieve no profits, no losses, in order to make total revenue equals total cost, how many units you need to sell, right? At the, let's say that is 1,000 units. When you sell 1,000 units, your profits would be, there won't be profits, there won't be losses. How do you interpret this line? That means, let's say A. How do you interpret A? What do you think? How do you interpret A? A means what? That is revenue. This is revenue, total cost and revenue. How do you interpret A? To be at the break-even point, to reach the break-even point, to reach the point where no profits and no losses, no profits or no losses, how much of sales we need to make? Now, when you think about your organization, in order to be at the break even, how much of sales you need to make? So, always you need to try to go beyond your break even sales in order to make profits. Now, when you reach 1 million, let's say this is 1 million, when you reach your sales 1 million rupees, you are break even. That means you have covered your cost. But if you want to make profits, you need to sell more than 1 million. More than 1 million. When you exceed your break-even point, you will make profits. So in that case, this is the break-even point. Total revenue equals total cost. This area, I would say this area, the difference between revenue and cost. From this point, this area, we identify as profits. Profits. When you exceed Z quantity, when you exceed A sales revenue, you have profits. But let's say you are below A and you are below Z. That means you are below break-even point. What do you make? This area? What do you make in this area? These are losses or profits? Losses. So when you go beyond break-even point, your organization will be making profits. When you go below break-even point, your organization will be making losses. So in order to be at a point where no profits and no losses, you have to be at the break-even point. So always your organization should try to increase or go beyond the break-even point to make profits. So this is how you can interpret break-even point, that concept, using this graph. Okay, right. Right. Next concept, contribution. Contribution. What do you mean by contribution? What do you know about contribution? Now it says contribution is the difference between sales value and the variable cost. Sales value and the variable cost. I can write it like this. Contribution. I can write contribution per unit and total contribution. So if I say contribution per unit equals what? Can somebody tell me the formula if you can remember? Contribution per unit. You take what? You take the selling price. Exactly. You take the selling price and you deduct what? You deduct the variable cost per unit, right? You deduct variable cost per unit from the selling price. What about that? Now, if the selling price is 100 rupees, And your variable cost is variable cost per unit. What is included in the variable cost per unit? Direct material cost per unit, direct labor cost per unit, direct other cost per unit, and then variable overhead cost per unit. If you deduct all these variable cost components, that means, let's say 30 rupees, what is the contribution? What is the contribution per unit? 70. Contribution per unit is 70. What is the meaning of this concept? What is the meaning of this concept? That is the important thing. Identify or remembering the formula, calculating the contribution per unit is easy. What is the meaning, true meaning of this contribution per unit concept? Why do we have this contribution? Exactly. This is contributing to what? Contribution per unit is 70. In this example, contribution per unit is 70. Contribution to what? Contribution to fixed cost. Contribution to fixed cost, right? 70 we have to cover fixed cost of the production, correct? Contribution to fixed cost. Now, when the selling price is 100, if you can remove all these variable costs we incurred to manufacture that product, that means 30 rupees, we have earned 100, we have removed 30, we have 70 rupees left with us. We can use that 70 rupees to cover what? Our fixed cost of the organization. That is the concept. After removing, after paying off all these variable costs, we have something left. We can use that remaining part to cover our fixed cost. So contribution is contribution for the fixed cost. Contribution for the fixed cost. Right? Right. Okay. In that case, shall we calculate contribution, total contribution as well? Total contribution, that is contribution per unit. Can you give me the formula for total contribution? How can we calculate total contribution? We have a question. Is it fixed cost of production? No, fixed cost of the whole organization. Is that the question? That means you're talking about, is it fixed cost, manufacturing related fixed cost, or all fixed cost of the organization? We are talking about the full fixed cost of the organization. Full fixed cost. That means it can be manufacturing, it can be admin related fixed cost. That means, what is that? What is an example for admin related fixed cost? Let's say we have a office building. That means head office building is a rent. Exactly. Our head office is located at a rented building. So that is an admin related expense, that rent, and it is fixed, right? Fixed for the period. That is admin related fixed cost. We are talking about all these fixed costs, not only manufacturing related fixed cost. What is the contribution we have from each unit to cover all our fixed costs, not only manufacturing? Is that clear? Yes, the salary of admin staff, if it is fixed, yes. We are having fixed salaries for accountants, fixed salaries for admin, whatever the officers. So yeah, there are some variable cost in the non-production. Then it is ignored. No, there are some way. We can include all variable cost. We are talking about the whole business, no? We are talking about the whole business. In that case, we can include everything, variable cost also. We are taking the full fixed, we are taking full variable. Is that clear? Yes, sure. Now the thing is, if we take contribution per unit, selling price is very clear. Variable cost per unit. Have I written manufacturing variable cost per unit or variable manufacturing cost per unit? I think that's the concern. This is not variable manufacturing cost per unit. Even though we identify manufacturing costs as examples, but this is total variable cost. Now let's say if we have if we have a sales commission paid for each unit we sell, let's say we are paying a commission for each selling unit. That is what? That is a variable cost per unit. Is it production or is it selling and distribution related? If we say a sales commission, when you sell a unit, we pay a commission for the sales representative. That is a commission paid per unit. Can you remember in last week we had that budget figure? For each and every unit you sell, you paid a commission. So in that case, is that manufacturing? No, it is selling and distribution related. But still, do we take that sales commission as a variable cost when we calculate this contribution per unit? Do we consider that sales commission? Yes, we consider that. Not only manufacturing. Now, in that case, I hope your doubt is clear. Is that so? Okay, very good. Really, it's really nice you clear your doubts. So this is not only manufacturing variable cost, all variable cost. Okay. Remember that sales commission example. That is selling and distribution, as many of you have explained, right? So in that case, you take all variable cost. So we have 70 rupees left with us. From that 70 rupees, we can cover the fixed cost, right? Okay, I will explain more about that concept after calculating total contribution. Now, tell me the formula for total contribution as well. You know the contribution per unit we can calculate by taking the selling price by deducting variable cost per unit. That's true. What about total contribution? How can we calculate total contribution? Instead of selling price, what do we can get? There are two ways to calculate. I'm talking about the formula method. What is instead of selling price? Selling price is for one unit, no? We take revenue. We take revenue instead of selling price. Instead of variable cost per unit, we take total variable cost. Plural, total variable cost. So in that case, we have total contribution. Or else we can simply multiply contribution per unit, 70, by the number of sales units, right? Number of sales units you can multiply. That is true. But this is the formula, revenue minus total variable cost. Right. I will give you a simple example. Selling price is 100. Variable cost per unit is 20. Sales quantity is 10,000. And your, give me a second, since I'm and your fixed cost is 500,000 rupees. Can I know the contribution, total contribution? Can I know the total contribution? Total contribution. How much is the total contribution? What's the answer? Total contribution. That means there are two ways. You can calculate contribution per unit and multiply by the sales quantity, or you can calculate total revenue minus total variable cost as well. But I will take contribution per unit. That's easy. Contribution per unit. That is you have a selling price of 100 rupees minus you have a variable cost per unit of 20, 80 rupees. Our sales quantity, total contribution, our sales quantity is 10,000 units. So if I can just multiply 80 by 10,000, I have 800,000 rupees as the total contribution. Okay. Now, what about our fixed cost? How much is the fixed cost? How much is the fixed cost? How much is the fixed cost? 500,000, isn't it? Fixed cost is 500,000. Now, if I take this area as the 800,000 rupees, this area as the 800,000 rupees, and then this is the fixed cost of 500,000 rupees. This is total area was 800,000 rupees. That was our total contribution after removing the variable cost. What is the amount? And then this is fixed cost. So we used our total contribution. That means we used our total contribution. And then from that, we covered our fixed cost, 500,000 rupees. What is this? What is this balance yellow colored area? What is this balance yellow color area? This is the profit. This is the profit. So as you can see, if I draw like this, the whole picture, I would say yellow color is revenue. This is revenue, total revenue. Shall we remove total variable cost? Total variable cost. Let's say this is total variable cost. Okay. This green color is total variable cost. Total TVC. Now tell me, what is this remaining yellow color area? Remaining yellow color area? Contribution. Remaining yellow color area? Think again. This total yellow color area was revenue. Revenue. From revenue, we removed total variable cost. Total revenue minus total variable cost. Now, what is this remaining yellow color area? Remaining yellow color area. Total contribution. Contribution is correct. Now, is this fixed cost? Is that clear, Tharinda? Is this fixed cost? Yes. This is total contribution. This is total contribution, isn't it? Total revenue minus total variable cost, total contribution. Now, from this total contribution, that means we have made sales. After having sales, we have removed the variable cost. Now we have something left, that is our contribution. Now that contribution is to cover fixed cost. Now this is our fixed cost. This is our fixed cost. This maroon color area is the fixed cost. This is fixed cost. Okay, now we have covered from the contribution. We removed fixed cost as well. That means we paid for fixed cost as well. Now what is this remaining yellow color area? Now what is this remaining yellow color area? Profits. Profits. Are you clear? This is profits. This is the relationship. From the total revenue, you remove variable cost. You have the contribution. From that contribution, you pay your fixed cost. And then what is left with you is the profit. What is left with you is the profit. That is the relationship, right? So how can we calculate the profit then? How can we calculate the profit then? What is the normal formula for profits? What is your normal formula for profits? How can we calculate profit of an organization? Normal formula. Total revenue minus total cost. That means TR, yes, TR minus TC. Total revenue minus total cost. But now you know one new formula. What is that? Profits equals what? Profits equal what? Profits equal total contribution minus what? Total contribution minus what? With the knowledge you have after our discussion, now you can tell me the answer. Our usual normal formula to calculate profit is TR minus TC. But if we have total contribution, yes, if we have total contribution, by deducting something from the total contribution, we can calculate our profits. Very good. So profit equals total contribution minus fixed cost. Total contribution minus fixed cost. Right? Are you clear? This new formula, if you have the total contribution, if you can deduct fixed cost, that means if you can remove this fixed cost part from the total contribution, you have profits with you. Right. I hope that's clear. Any doubts? Are you clear? Any doubts? Any doubts? No doubts or all are doubts? Right. Thanks. Okay, now we'll see the slides. Now we discuss these things using the Excel. Total contribution equals, you take total revenue and then you deduct total variable cost. That is what you have to cover your fixed cost. Remember, contribution for the fixed cost. Here, you have another small example. Why don't you do it? Very small one. Selling price per unit is 200 rupees. Direct material per unit is 20 rupees. Direct labor per unit is 30 rupees. Variable overhead per unit is 20 rupees. And then fixed overhead per unit at 1000 unit is 50 rupees. What is the contribution per unit? Calculate the contribution per unit, please. What's the contribution per unit? Your selling price is 200, direct material 20, direct labor 30, variable overhead 20. So if your selling price is 200 rupees, what is your variable cost per unit? Variable cost per unit would be 20, 30 and 20. Altogether you have 70. So exactly, when you deduct 200, when you deduct 70 from 200, you have 130. 130 would be the contribution per unit. Very correct, right? So now you know the concept. Another one, CS ratio. You call it contribution margin ratio, CS ratio. What is CS ratio? C means CS, CS ratio, CS ratio. C stands for contribution. C stands for contribution divided by what? S stands for selling price. Now that this should be contribution per unit, I would say, because we are taking selling price per unit. So if we have contribution per unit divided by selling price, you have the CS ratio. Now in that example, in the previous example, can you calculate the CS ratio? Can you calculate the CS ratio? Contribution per unit divided by the selling price. What was the contribution per unit earlier? 130. Am I correct? 130. Yes, 130. So 130 divided by Selling price was 200. 130 divided by 200. 130 divided by 200. As a percentage, it is 65%. Yes, 65%, correct. What is the meaning of this? How do you interpret this CS ratio 65%? From the revenue or from your selling price, 65% of it you can use for fixed cost covering. You can use 65% of the sales revenue. You can use 65% of your total revenue to cover the fixed cost. Exactly. Every 1 rupee sales will generate 65 cents to cover fixed cost. Very correct. So that is the meaning of it. Is it good to increase CS ratio? Or what do you think? Do we have to increase the CS ratio of our organizations or what? What is better? Higher CS ratio or a lower CS ratio? What do you think? What do you think? Higher the CS ratio, good to increase the rate, but it depends on industry. Yes, exactly. But in a normal organization with all these assumptions, it's good. CS ratio is higher means you have your selling price, you have covered your variable cost as well. That means you have very less amount of variable cost. You have reduced your variable cost as much as possible, and you have contribution. It's a lot. If you have 65%, that means very good. From that, you can cover your fixed cost. Remaining would be your profits. So higher the better, right? And then that is CS ratio concept. So if we take total contribution and total sales, that is also possible. So instead of unit contribution, you can take total contribution divided by, instead of selling price, you can take total sales multiplied by 100. So both ways, singular or plural, both ways you can calculate CS ratio. Right. Now previously, I explained you the normal formula for profits, and then I explained you this new formula as well. This new formula. See how it comes. See the mathematical, how can we arrive at this formula mathematically? How to derive this formula mathematically? Now, if we can use, I will show you. If we can use this, profits equals TR minus TC, total revenue minus total cost. If I rewrite the profit formula, if I rewrite TR minus, instead of total cost, we can use the two components coming under total cost. What are those? Total variable cost and total fixed cost. So if I can write it like this, total revenue minus, within brackets, I use TC means what? Total variable cost plus total fixed cost. Am I right? Are you clear? Instead of writing total cost minus total cost, I write minus, but within brackets, TVC plus TFC, the components coming under TC. Now I remove brackets. TR minus plus, that means minus TVC, minus plus again TFC. So from total revenue, you remove total variable cost, you remove total fixed cost, you have profits. That means you remove your total cost from the total revenue. You ended up having profits. I'm changing the order. Now, no. Can you give me another term for this one? TR minus TVC. For this part, can you give me another name, another term for this? This red color one. TR minus TVC, what? Total contribution. Instead of TR minus TVC, you can write exactly total contribution. So I'm writing total contribution total contribution minus TFC. It's already there, TFC. So I wrote total contribution instead of TR minus TVC in the formula we know. So this is how we arrive at this formula. Profits equals total contribution minus total fixed cost. Are you clear? This is how we mathematically derive at this, the second formula. From the same formula we know. Total contribution minus total fixed cost. Right. So this is how it explained in the profit equation slide. And another thing, what do you think about this? How can we interpret this? How do you interpret this? Now, total contribution. Total contribution. If I say total contribution equals, that means I'm writing the same formula again. I want to keep total contribution this side. And to keep that, I take minus TFC to left side. That becomes what? Profit. Instead of minus TFC, I write it as plus TFC equals total contribution. Total contribution. Right? So if I write it like this, total contribution equals total contribution equals profits and fixed costs. Or it says total fixed cost plus profits. That means contribution is there to cover the fixed cost and the remaining part would be the profits. That's the reality. Are you clear? Total contribution is there to cover the fixed costs and to remaining part will be covered. Remaining part would be the profits. So total contribution equals TFC plus profits. Now my question is, if the fixed cost is lower than total contribution, what is remaining? If the fixed cost is lower than total contribution, what is remaining? If the fixed cost is lower than total contribution, that means it's like this. Total contribution is greater than total fixed cost. What is the answer? It's profits. It's profits. If the total contribution is greater than fixed cost, that means you have profits. That means, let's say your total contribution is 100,000 and your fixed cost is 80, then you have a profit because profit equals total contribution minus total fixed cost. What if you have your fixed cost is greater than your total contribution? What do you have? Your fixed cost is greater than your total contribution. That means your fixed cost is 100. Your total contribution is only 60. You ended up having losses. Your fixed cost is greater. Your organization's fixed cost is greater than your total contribution. That means you ended up having losses. Now, if your total contribution equals fixed cost, what do you have? You have a total contribution of 100. Your fixed cost is also 100. What do you have? Then what is this? Break-even point. Break-even point. Your total contribution equals total fixed cost means you don't have anything to cover your profits. That means what? Break-even. So another interpretation for your break-even, I would say. So previously we told break-even point is the point where TR equals TC. Are you clear? Previously we told BEP is point where TR equals TC. Now give me another relationship for this. Break-even point is where total contribution equals fixed cost. Where your total contribution equals fixed cost. This is what? Total contribution equals fixed cost. That is the break-even. Right. So are you clear with these concepts? Are you clear with these concepts? So you can apply, especially when if you are having a project, if you are having, even though it's a very small project, it can be a fundraising project or any organization operating projects, you can apply these concepts to get initial decisions, I would say. Now, in your organization, if you have one section, if you have one product to be at the break-even point, how many units we need to sell? When you exceed that quantity, you start making profits. If you go below that quantity, you ended up having losses, right? If you are increasing your fixed cost, let's say if you are increasing your fixed cost, what will happen to your profits? You can identify through this, right? If your selling prices are fixed, if your variable cost, you know how to calculate the contribution, you know the existing fixed cost. But let's say in the long run, you are going to increase your fixed cost. You are going to have another factory for your company, a rented building factory. What will happen to your profits? So likewise, with the changes in these items, you can calculate your profits. You can decide whether we need to increase the prices or decrease the prices, right? Whether we need to negotiate with the suppliers to reduce the cost, whether we need to reduce our fixed cost. Likewise, you can always use these small, very simple formulas for initial decision making, right? Okay, now tell me your experience. Before we go to this activity, what is your experience? Have you used these formulas, break-even points in your organization? What is your experience? Yes, right? Yes, as an initial decision-making tool in the short run, obviously you can use. Now, one small example. Shall we quickly do this? Activity 5.1. It says Swadeshi Lanka Products Limited engaged in manufacturing baby care products. Following information is relevant for a tablet of baby soap produced by the company. So it says direct material cost is this much, direct labor cost is this much, other variable cost per unit is this much. So altogether, variable cost per unit is 25 rupees. Selling price per unit is 100. Okay, no need to read the rest. Can you tell me contribution per unit? What is the contribution per unit? Contribution per unit? If your selling price is 100, if your variable cost per unit is 25, your contribution per unit would be 75 rupees. Correct. The fixed overhead cost for the month is 15 million. During the month of September, Swadeshi produced 1 million tablets of soap. Okay, you have a fixed cost of 15 million. Compare the total contribution. Now calculate the total contribution. You have contribution per unit 75. You know the quantity of 1 million. How much is the total contribution? 75 million. 1 million multiplied by 75 rupees, 75 million. Correct. What is your CS ratio? What is your CS ratio? CS ratio. CS ratio, contribution per unit divided by selling price, I would say. Contribution per unit is 75, selling price is 100, 75 divided by 100. 75%. 75%. I'm not making these calculations because that's easy, right? 75 divided by 100, 75%. That is your contribution margin ratio, CS ratio, right? Find out the operating profit of Swadeshi for the month of September. Calculate the profit now. How much is the profit? What is the formula now you need to use? It's not the ordinary formula, TR minus TC. You can use total contribution minus total fixed cost. You have already calculated your total contribution as 75 million. And you have your fixed cost amounting to 15 million. 75 million minus 15 million, exactly. Your profit would be 60 million. Your profit would be 60 million. That's how you understand. Okay, that's how you calculate. Right. Okay, you have 60 million. This is how you calculate. Okay, now, even though we discussed break-even point and everything, we didn't discuss the formula yet, right? We know that break-even point is the level of activity where our organization neither enjoys any profits nor losses. No profits, no losses. And in other words, total revenue equals total cost. That is also correct. What is the other relationship that we discussed? In the break-even point, what equals to what? TR equals TC, we know that. In addition to that, what's the relationship we discussed? Exactly. Total contribution equals to total fixed cost. Total contribution equals to total fixed cost. Very correct. Okay. Now, how can we calculate this break-even point? We know that the point is, we can graphically identify the point. How can we calculate the break-even point? Now, there are two formulas we can use. Break-even point in units and break-even point in rupees. Break-even point in units means what? How many units you need to sell to be at the break-even point? How many units you need to sell? How can we calculate it? You take the fixed cost. You divide it by contribution per unit. Contribution per unit. Fixed cost divided by contribution per unit. How can we calculate break-even point in rupees? That means, what's the interpretation? How much of sales you need to make to be at the break-even point? How much of sales in rupees? That is same fixed cost. You take fixed cost divided by, instead of contribution per unit, you divide it by the CS ratio we discussed. So fixed cost divided by contribution per unit, or fixed cost divided by CES ratio. That's how you calculate mathematically break-even point in units and break-even point in rupees. Okay, are you clear? Now calculate the break-even point in units and sales. Sales value, not 6.1, 5.1 actually. From this one, calculate break-even point in units, break-even point in rupees. Break-even point in units, you calculate by dividing fixed cost divided by contribution per unit. Your fixed cost is your fixed cost is 15 million. How much is your contribution per unit? If I'm correct, it's 75. Let's see. Is it 200,000 units? 200,000 units? Yes, right? Yeah. Others, is it 200,000 units? Break-even point? That means you need to sell 200,000 units in your organization to be at the break-even point. So in order to start making profits, you need to sell at least 201 unit, right? You need to exceed this level. What is break-even point in rupees? That means fixed cost divided by CS ratio. Fixed cost divided by CS ratio. Fixed cost is 15 million. What was the CS ratio? 75%, isn't it? 75%. So I'm writing it as 0.75. 0.75. So divided by 0.75, you have 20 million rupees. Exactly correct. 20 million units. 20 million rupees. So you can write it as rupees 20 million. That means in order to be at the break-even point, you need to have sales of 20 million. That is how you calculate break-even point. Right. Last concept before the break. Okay. Now, what is this? Now you can use, if I tell you, yes, and then I'm not actually discussing the multi-product method here, but we can use multi-product methods as well. If you have multiple products, you have to use mix of products actually. And then you calculate these contributions, and there's a different way of calculating these things for a mix method. This formula you can straightforward use for a single product producing company. Let's say you have 3 products. In that case, in order to apply these concepts in a multi-product company, you need to know the sales mix. Sales mix. That means I'm not explaining the whole concept. I don't have time for that. But I will definitely share the chapter with you. Then it would be easy. Let's say you have 3 products called ABC. Now you need to know the sales mix. Sales mix. Let's say 2 to 4 to 6. No, 2 to 4 to 5. Likewise, you need to identify the mix. In that case, you can calculate the contributions. If you can calculate weighted average contributions, then you can end up having these concepts. Are you clear? Now, the previous formula, this is definitely for a single product. Single product. That means you can identify, yes. That means you have not received the PDF, right? If needed, I can drop you in the textbooks. No, there are only 24 participants now. I will ask CMA to email the chapter. They have the chapter. Is that all right? Right, sure. So, okay. Now that is how we use. Now, if I just write the fixed break-even point, BEP units formula again. What is the formula? We write fixed cost divided by contribution per unit. Divided by contribution per unit. Like this. Now, when you calculate break-even point, what is the interpretation again? How many units to sell, to be sold, to be at break even. This is the meaning. This is the meaning. Are you clear? Break-even point in units means how many units you need to sell to be at the break-even. At the break-even, what is the profit? How much is the profit at the break-even? At the break even, how much is the profit? 0. You don't have profits at the break even, so profit is 0. Now, I can use the same formula to ask a question like this. How many units to be sold to, now previously I asked the question to be at the break even. That means, in other words, to earn 0 profits. That means how many units to be at the break even, how many units to be sold to earn 0 profits. To earn 0 profits. The same question I can ask again, how many units to be sold to earn, let's say we have a target profit. We have a target profit of 2 million, 2 million, not 2 million, 1 million, 1 million. To earn rupees 1 million, let's say we have a target. Now we need to have a profit of 1 million. Now we don't know how many units you need to sell to earn a profit of 1 million. We can use the same formula with a small modification, right? What is the formula? Now, previously, we asked the same question, how many units you need to be sold to be at the break-even point? That means how many units to be sold to earn 0 profits. Now, when we were writing this original formula, we were talking about 0 profits now. That profit figure was here actually. That is how fixed cost plus profits. That means the target profit. The target profit. It was here. It was here, right? When we were writing the original BEP formula, target profit was there. But target profit was how much? When we were talking about break even, target profit was how much? 0. 0, right? So in that case, we didn't write that. We didn't mention that because we are talking about 0. No, we didn't mention that. Now, if you want to have a profit, you can include that. So we can write fixed cost plus the target profit divided by contribution per unit. Contribution per unit. Are you clear? Previously also this target profit was here, but we didn't write because we were talking about break even. At the break even point, we don't have profits. So we didn't show that component in the formula. But if we really want to earn a profit, we include that as well. We include that as well to the fixed cost. So fixed cost plus target profit divided by contribution per unit. Then it gives you how many units you need, how many units to be sold to earn 1 million rupees. Let's say in the same example, our fixed cost 15 million, isn't it? 15 million. How much is our contribution? It's 75. Contribution per unit 75. Now, what was the break-even point? What was the break-even point of that same example? 200,000 units. 200,000 units. 200,000 units you need to sell to be at the break-even. Now, give me the answer. If we want to make 1 million profits, how many units we need to sell? Previously, to be at the break-even point, we had to sell 200 units, 200,000 units. Now, if you want to have 1 million profit, how many units you need to sell? How can we calculate? You take fixed cost. That is 15 million plus you add 1 million. 1 million divided by contribution per unit, that is 75. So, is that the number you get? 230 13,333 or 34 units. Are you clear? Previously, to be at the break even, you need to sell only 200,000 units. But if you want to make 1 million profit, you need to sell this much of units, this many of units. Are you clear with the concept? Did you get the same answer? Yes, no? 213,334 or 33 units. This is how you can plan your organization if you have a single product. And then if we want to know, now this is about number of units, no? If we want to know the sales revenue in rupees, that means if my question is how much of sales, that's not about the units. Previously my question was how many units to be sold to earn this much of profits. But how much of sales we need to make to earn 1 million rupees profit. Now what is your answer? How can we calculate it? Now how can we calculate? Now instead of contribution per unit, what was the previous BEP rupees formula? Fixed cost divided by CS ratio. Same thing you can do. You write it like fixed cost. Now you add the target profit as well because you have a target profit. Previously the target profit was 0. That's why you didn't write. Divided by CS ratio. Now not previously, your fixed cost was 15 million. Fixed cost was 15 million and then you need to add the target profit. That means this much, right? This means $16 million. And then what is your CS ratio? CS ratio is 0.75. Previously we calculated. So how can we get the sales rupees value? 21,333,000. 21 million sales. How much of sales we need to make to earn 1 million rupees profit? 21 million sales. Previously, it was only 20 million sales. To be at the break even, 20 million sales enough. But to earn 1 million rupees profit, 21 million sales. So this is how you can use break-even point formula for target profits, to earn target profits. So this is how target sales in units, you need to add the target profit, contribution per unit can be divided. And then if you want to have target sales value in rupees, you add target profit to fixed cost divided by CES ratio. That means contribution margin ratio. This is how you discuss. This is how you use the same break-even point formula for profit planning. Right. Last example, shall we quickly do? A manufacturing firm provides the following information. That is, selling price is 80, variable cost per unit is 60. That means how much is the contribution per unit? Selling price minus variable cost per unit, 20, right? It's really easy, 20. Then it says the total fixed cost is 120,000. Firm is expecting to earn 80,000 profit in the next year. Calculate the required sales to earn this target profit. Quickly tell me the answer. That means you can take the fixed cost 120,000. You can take the fixed cost 120,000. You need to add the target profit of 80,000. So 120,000 fixed cost plus the target profit of 80,000, that is 200,000 divided by CS ratio. CS ratio means C means the contribution. How much is the contribution? Selling price minus variable cost, you have 20. So 20 divided by S main selling price 80. So 20 divided by 80. This is your CS ratio, 0.25. So 200,000 divided by 0.25. You need to have 800,000 sales. Yes, correct. 800,000 sales. Are you clear? This is how you can simply calculate these things. Right. So with that, we are finishing CVP analysis. Basically, that is for a single product. That is the very simple very simple format, I would say. But if you have multiple products, that's a different story. But using the same concepts, we can calculate those things. But we are not covering these things with the time constraints we have, as this is a short course. But having learned these fundamentals, you will be able to identify those things because now you are clear with the fundamentals and all, right? If you have any issues, you can ask. If you have any issues, you can ask before the break, and then after the break, we can start with pricing. Any clarifications?
Natasha, I have two questions.
Yes.
Okay, the first is this is basically can be used as a simulation exercise for a new product launch. Am I
Yes.
correct? Right?
Yes,
So,
correct.
so in that case, rather than considering everything to be constant, the fixed cost is going to be fixed, right? It's constant.
Yes.
But all the
Okay.
others we can simulate, and for instance, the selling price we can simulate and assume all the others are constant. So we can always simulate changing one component but keeping all the others constant.
Yes.
And then that
Correct.
way we will be able to arrive at the flexibility
Yes.
of raw material costs, wages costs, and the selling price, right?
Exactly. Yes, correct. Now, that's why I previously mentioned. Now, if we increase, let's say we have a fixed cost, but if we have a plan to have a new building and a rented building, that fixed cost would increase. So, if we increase the fixed cost, what would be the impact on the profit? Likewise, you can simulate, definitely. Now, if you don't know the price, now let's say for the new product, you still don't know the correct price. You have to decide the price. So all other variables are fixed. You can have 20. If our price is 20, will there be profits if we sell 100 units? What if our product price is 50? What is the impact on the profit? Likewise, you can always find. That's totally correct.
Right. The second thing is uh, it's based on capacity. Like, okay, we know our contribution, right?
Hmm.
And
Hmm.
if we have spare capacity, when I say capacity, that's equal to fixed cost, right? Capacity is
Hmm.
fixed cost. So if we have
Yes.
spare capacity
Hmm.
and the contribution is contributing towards that fixed cost, then we
Hmm.
can always even reduce the price, go for a product mix with a lower margin
Hmm.
because it will help in contributing towards the fixed cost. When I say capacity available, what I'm
Hmm.
saying is that means we are not covering the full fixed cost, obviously, right? So
Hmm.
if we have free capacity in our machinery, like the machines are idling or some machines are idling, that means we
Hmm.
have free capacity. So
Hmm.
to fill that capacity, we can go for a lower contribution because rather than looking at the total cost, because
Hmm.
the total cost is actually not being utilized because
Hmm.
machines are idling.
Free. Yes.
So
Idle capacity is there.
yeah, idle capacity. So in that scenario, we can go for lower contribution because it still contributes toward the covering of the fixed costs.
Exactly.
Mm.
Now, in that case, now let's say factory rent is there. That factory has 100 units capacity. And then you are at the current capacity level of 80,000 units.
Yeah, Natasha, actually, it is more applicable for machinery because
Okay,
building is of
yes.
course difficult.
Right,
Yeah,
yes.
yeah, yeah.
In that thing.
If
So
machines
let's
are idling,
say in
then
that
you
case,
can.
you have to pay for that machinery, isn't it? You have
That's
in
right.
that
Yeah, yeah,
case.
yeah.
Fixed cost, in that fixed cost you are paying for 100 units capacity, but you are currently utilizing only 80. Am I correct?
Yeah, yeah,
Yeah. So in that case, yes, correct.
yeah.
Your story is correct. Now, again, what is your industry? Previously also you mentioned, right?
Yeah, we are
MBA
in
is related.
labels. We do labels for
Yeah, okay. So do you use these actually? Now we were talking about these theoretical aspects. You apply, really apply these concepts in the business scenario? What
we
is your
do.
experience?
We do really apply. Now, for instance, earlier that we do, like if it's a new product launch, we do a
Hmm.
simulation exercise. We take a new product, and
Hmm.
we know that the fixed cost is fixed, so we don't mess around with that. But we
Hmm.
take the raw material and wages also is actually fixed or semi-fixed. I mean, unless it's overtime. So
Hmm.
wages also we leave aside, but then we take the selling price and the raw
Hmm.
material cost, and we can simulate that
Hmm.
and
Hmm.
then see the effect on the contribution and the profit.
So
And
I
then
would say
we
that is
always,
sensitivity analysis, isn't
yeah,
it?
yeah, that's right. Yes, yeah.
Yes.
So then
So
also
yes.
we do. I mean, if we have capacity,
Hmm.
very often, of course, if it's a slow moving stock raw material stock item, we will just drop the price and
Hmm.
sell it just to fill the capacity so that we are contributing something towards that fixed cost which is not being utilized.
Yes, always.
Yeah,
Even though you are not utilizing, fixed cost is fixed and you have to pay for that, isn't it?
that's right. Yes.
Yes. So it's better if we can, that efficiency matters, using the full capacity and all, right? Because anyway, even though we are not using, if you are keeping your idle capacity always,
Yeah.
you have to pay. There's a cost. That's
Same with
why it's,
wages. Same with wages because the fixed component
yes,
are the wages we have to pay. So we might as well
yes.
yeah, full capacity.
In that means inefficiency of labor. That means if we are paying monthly salary, that means fixed, no, monthly fixed.
No,
But if
what
they are not
happens is
working,
when there are seasonal fluctuations, it
hmm,
can result
hmm,
in free capacity. So,
hmm,
so then we need to. I mean, the industry is such that there can be fluctuation. Yeah, I mean, directly linked to exports, right? So apparel
yes,
industry and all.
hmm,
When there are fluctuations, we will take other orders at
hmm,
lower contribution, right? So that it can
yes.
contribute towards the fixed cost.
That's why these apparel companies are using contract laborers, like,
That's
because
right.
in the
Yeah.
season they are recruiting, and but they are not
Yeah.
permanent staff.
But you
That's one
can't do that with
strategy.
machinery. Machinery is yours, so
Yes.
you use that. Yeah.
Can't you rent the machines for the season? I can remember that was there for Ms. Intimates, but I don't know in your company.
No,
Now,
we don't rent. We own the
okay, you have to purchase.
yeah.
Yes,
Unless of course we shift it amongst the rest of the group, something
right.
brings the cost. Yeah.
Yes, true. Very interesting. Thank you very much for sharing the experience. Okay, your clarifications done, no?
Yeah, yeah, thank you.
Okay, okay. Thank you very much again. So it's 10:15. We'll have a 10 minutes break. We'll again start at 10:25 and try to finish the second part. Thank you.
Natasha, hello.
Yes.
You don't mind me, using the mic rather than typing. Is that okay? I mean, I
No
don't
worries at all.
disturbing.
That's easy for me. Yes.
It's easy for
I
me.
want everybody to talk, but only you are talking. That's really no problem. No
Yeah, yeah,
problem
yeah.
at all.
Thanks, thanks.
Yes. Right. So we'll start the second part of today's lesson. I hope you all are there. This is pricing. So we have discussed break-even point, profit planning, contribution per unit, all these things coming under CVP analysis. And then we are moving to pricing. These two topics are not related, but we have just taken these two topics just to cover the content, right? Remember that. So coming under pricing, these are the session objectives you are going to learn. I have one question. What are the major factors influencing the pricing decisions of an organization? I would say there are internal factors and external factors. What is your idea? What do you think? What are the factors affecting our pricing decisions? Now, any organization, if it is not a not-for-profit organization, I would say, still there are prices for products, for goods and services. We need to have a price, right? If not, we don't have a sales revenue. So when you are deciding your price of a product, it can be a new product or it can be an existing product, I would say. For a new product, definitely you need to come up with the price. But for an existing product also, you need to see whether this price is true, whether this price is accurate. Now, previously, you have decided the price of that product 10 years back. Now, this is 2025. Now, is that price okay for the current context, right? Do we need a price revision? Likewise, what are the factors affecting this decision, pricing decisions? What do you think? What is the main factor? There are so many factors. What's the main factor? What's the main factor affecting this pricing decision? Exactly the cost. Correct. Cost is important. If the price is lower than the cost, that is a mess, right? We are ended up having losses. So in that case, cost is very important. That is true. Cost. And then organizational goals. What do you think about that? That means some organizations, they have strategies. They have pricing strategies. They want to earn profits in the short run. Within a very short period, they want to earn the maximum profit they can earn. Sometimes some organizations are trying to achieve profits in the long run by with small proportions, I would say. Sometimes some organizations are positioning them as market leaders or best quality providers in the market, premium product suppliers in the market. So different objectives, different goals are there. That is also important. If the organization is trying to accumulate profits as much as possible, as soon as possible, I would say, in a very short period, they would go for a higher price. So that is objectives, that is the goal of an organization. So those are important when pricing. And then organizational factors. If the cost, if the changes of the direct materials, if the price changes, price revisions of the direct materials, if the price revisions of the direct labor they are using for the production, that is very important in an organization. If there are, if the material they are going to use for the production is very rare and that should be purchased from other countries, so organizational factors are there likewise. So the price would be different, right? And then distribution channel, whether you are using your own distribution channel or whether you are using a third party distribution party. So in that case, if you are using your own distribution panel, you will have to take care of the vehicle maintenance, fuel cost, driver salary and everything. But we don't know what is the cost if we are using a third party distributor. So in that case, price would be different. We have to think about those things when we are pricing a product. Let's say it's not only about the manufacturing cost you need to think of when you are deciding the price. Let's say direct material, direct labor, direct other manufacturing overhead cost. When you take all these things, you can take cost per unit, and then you can decide the selling price by adding a percentage. But that's not the case. When you are deciding the price, you need to think about the whole cost structure of an organization because it's not only the manufacturing cost you are going to cover through the price, right? You have to cover everything. You have to cover the admin cost. You have to cover the selling and distribution cost. You have to cover the finance cost. If you have taken so many bank loans, if you have OD facilities obtained, you have to pay the interest. So through the price, you earn revenue, and that revenue should be sufficient enough to cover everything. That's what we discussed in CVP as well, isn't it? So from the contribution, you need to cover the fixed cost. If the contribution is greater than your fixed cost, that remaining part would be your profit. So that's why when pricing a product, all these things should be considered. Not only the manufacturing, not only the manufacturing cost, all other cost. So that distribution cost also should be absorbed to the cost of your product. Then only you can come up with the real price. And then pricing objectives. There are some pricing strategies. We'll discuss that later. So based on the pricing objective also, your price would be different. Product characteristics. If you are giving very unique features, unique characteristics, then your price would be high. If you are selling a premium product, price would be high, expensive product. But if not, price would be lower. And then product differentiation. If you want to differentiate your product from the products in the market, other products in the market, sometimes you will increase your price, right? Sometimes you will decrease your price in order to be differentiated. So likewise, different things affect your pricing. What about external factors? What is the main external factor? Competition. If you decide your product as 100 rupees and the same product can be purchased from the market with other competitors, from other competitors at 95 rupees, your product demand would be less because your product is expensive compared to the other products in the market. So competition is very important, right? Competition you have to consider. You can't just ignore your competitors. You need to understand your competitors. What are their pricing strategies? That's why now if one similar product is giving a discount, you also trying to do something because discounts attract customers. If the prices are going to be low, then the customers will go for that product easily. Price elasticity of demand. Price elasticity means when when you change your price, what is the impact on the quantity? What is the impact on the demand? Sometimes even though the prices are very high, even though the companies are increasing their prices, demand won't reduce. Demand would be there. Now, sometimes when you increase the price, let's say by 1%, but the demand would decrease by 5%. Elasticity. Now, there are so many examples for those things. When you learn economics, I think you have learned these things most probably. Elasticity. Now, when you increase the price of a television, what will happen to the demand? Let's say when you increase the price of a television by, let's say, a bonds increases television prices by 2%. What will happen to the demand? What will happen to the demand? Demand will decrease now because that is the usual relationship. When the prices increase, demand will decrease. My question is, what is the percentage of that reduction in demand? When the advance is increasing the television prices by 2%, what will be the impact on the demand for that television? It will reduce by 2% or more than 2%? More than 2%. What is your answer? When the advance is increasing the television price by 2%, what will happen to the demand for that television? The demand will drop by more than 2%. More than 2%, right? What about sugar? What about sugar? Sugar is an essential commodity. So what will happen? When the sugar prices are high, what will happen to the demand? The market is increasing sugar prices by 3%. What will happen to the demand? Will the demand drop by 3% or more than 3%? Inelastic. So it's still people will buy and consume sugar. So different products are having different price elasticities. Based on that, you need to consider. So Abans will have to be very careful when they are increasing the prices, because there will be a definite drop in the demand, right? High elasticity. So different things can be there. Likewise, competitors' pricing policy, suppliers of raw materials. Obviously, if the supplier is increasing the raw material prices, then your price will have to reflect that, because you have to cover the cost, right? Economic conditions. Now, with the economic crisis we faced in Sri Lanka, the world economic crisis, I would say, now the prices are 3 times higher than the before COVID, right? Before the economic recession. Economic conditions. The consumers and businesses, let's say, consumers are trying to be very informative these days with the social media usage and everything. So they are well informed, they are very demanding. So we have to think about the prices now. And legal and regulatory issues, sometimes there are maximum prices set for, let's say, rice and all. There are maximum prices set for some products. So when you are deciding the prices of those kind of products, you have to be careful. What are the legal and regulated things, right? So likewise, you have so many factors affecting your pricing decision. Those are the examples. And now there are two types of pricing decisions, I would say, organizations: price takers and price setters. Price takers and setters. Who's a price taker? Price taker is a firm that have little or no influence over the prices of their products or services. They don't have power to influence the prices of the market. They have to take the price in the market and put that price as your product's price. Let's say there are two examples. When there are many firms in the industry and there is little to distinguish their products from each other, that means you all are selling a common product. Let's say firms in commodity market selling wheat, rice, sugar, bread, I would say. So there are so many small firms, many firms in the industry, and there's little to distinguish their product from each other. You will become a price taker. You can't decide. Let's say you are opening up a bakery tomorrow and you can't decide the price of a bread, because you have to take the price in the market, right? You have to take the price. You are a price taker. Or small firms operating in an industry where prices are set by the dominant market leaders. If you are a small company, small product you are selling, not a small product, you have a small company, but in that industry, there's one supplier, one competitor having a large market share. That market share is owned by that market leader, and that market leader will set the price. They have set the price. But you being a very small company having a very low market share, you won't have power to influence the price, to set your own price. You will have to take the price of that market leader. So little or no influence over the price takers, right? Remember. And then the next type is price setters. Price setters. Firms have some discretion over setting the selling prices of their products. Who are they? Selling products or services that are highly customized or differentiated from one another by special features. So if that's the case, price setter. You are unique, you are differentiated. So you can have your own market, you can have your own market share. So you set the price. You have the power for that. Or who are market leaders? You have so many commodities are there, the same commodities sold by many suppliers in the market, but small firms are there. But you are the market leader. In that case, you set the price. Other small prices having small market shares, they will take your price. So you are the setter. So those are the different types: price taker and price setter. Now, why? What is the importance? Why am I talking about these price setters and price takers in this pricing decision lesson? Importance of cost information. Now, why pricing is discussed under cost and management accounting discipline? This is the reason, because cost and management accounting doesn't have to do with pricing, I would say, right? But there is a relationship. This is the relationship. Now, if we take price setter, definitely as a price setter, we have to think about the cost. So why cost is important for price setters? For pricing decisions. That is obviously understood. No, to set the price, you need to have the cost. So that is why cost is important. Cost information is important for price setters. But for price takers, why? Price takers are not setting the price. They are just taking the price from the other companies. Why price takers? In deciding the output and mix of products and services to which their marketing effort should be directed, giving more emphasis on the prevailing market prices. That means if they are taking the price in the market, let's say price is already set, let's say a bread price is already set, you take the price. So you can't decide the price, you have to take it. Now you can do backward calculations. You know the price, and now you know need cost information to decide how much of what is the quantity, what should be the output we are going to produce and sell at this price, what should be the cost then, right? To decide the cost, to decide the mix of products, you need the cost information because you are doing a backward calculation. You have the price, now you need to manage the cost in order to achieve a profit, I would say, because you can't influence the price. Now, previously, you have the cost, you add a profit margin. With that, you have some price coming with the mathematical calculation. You set that price as the price of your product. But now it's not the case. You have the price. You have to decide, okay, how to manage the cost. What is the quantity you need to sell by managing this cost. Likewise. So that is the reason. For price setters, cost is directly influencing. For price takers, to decide the output and the mix of products, you need to have the cost information. Right, that is the importance of cost. Another concept, cost plus pricing. Now, I told you cost is very important for price setters. And then if you are using cost as the fundamental aspect when you are setting the price, you can say cost plus pricing. You take the cost, you add something, your profit margin is added, and then you set the price. So many companies use this cost plus pricing, but there are different ways you can use cost plus pricing. You can analyze your company. You can think about your company and see, okay, what is the method you are using if you are using cost plus pricing. One is different approaches are there. One approach is you take direct variable cost. You take direct variable cost, direct material, direct labor, direct other. You take your direct variable cost of your product. I would say 200 rupees. Let me take the pointer. Let's say 200 rupees direct variable cost, and then you add a markup. You add a markup of 150%. You add a markup. So when you calculate the markup, 200 multiplied by 150%, that is 300 rupees. That is your profit margin markup. Cost plus price is what? 200 rupees plus 300, 500 rupees. This is your cost plus price. What do you call this approach? Variable cost plus pricing. Because you calculated only the direct variable cost. Variable cost plus pricing. And another approach would be to the direct variable cost, you add direct fixed cost as well. Now you can calculate the fixed cost, and then you can, with a simple calculation by dividing by the number of units expected to produce, you can, let's say 100 rupees. Approximately, these are not correct numbers. Approximately 100 rupees would be your direct fixed cost. So you can come up with the total direct cost. Total direct cost, that is 300 rupees. Now you need to add a markup. That markup, let's say 70%. Previously you added 150. Now you're adding only 70%. That is 210. 300 plus 210 equals 510. Your price would be 510. What was the base you used? You used total direct cost. In that case, what is the approach? Direct cost plus price. Direct cost plus pricing. Let's say you can easily trace your direct variable cost, direct fixed cost, And also you can trace your overhead cost as well. You can trace in your company, that is easy, or that is somewhat easy to calculate or to identify your overhead cost. So divided by the number of units in the period with the past experience and all, with the overhead absorption rates, you identify, okay, 80 rupees would be the cost per unit. 80 rupees would be the cost per unit. Now, what is the total cost? It becomes 380. 300 plus 80, 380. Now you need to add a markup. 35%. 35%. See, the markup is reducing 35%. Now, what is the markup in rupees? It is only 133 rupees. 380 multiplied by 35%. Now, what is your cost plus pricing? 530. What is your cost base? Total cost. So, what is your approach? Full. You have taken the full cost, no? Full or long run cost plus pricing. Usually, we call this full cost plus pricing. You take the full cost, you add the margin plus pricing. Full cost plus pricing. So, different approaches are there. Now, I'll tell you why these markups are getting reduced. Why these markups are getting reduced. See the first one, variable cost pricing. What are the components there? We had direct variable cost, we had direct fixed cost, and then indirect overhead. Look at this table, right? Direct variable, direct fixed cost. So we have total direct, and then we added overhead, total cost. Now, direct variable cost, direct fixed cost. The other component was indirect overhead. These are direct variable, direct fixed. This is indirect overhead. And then something for the net profit. Now, if you are using variable cost pricing method, you need to calculate only the direct variable cost of your product. This is all because based on the traceability. In some organizations, it is easy to trace the cost items. Sometimes it is difficult. So in a difficult scenario, you can take only the direct variable cost. Why? Tracing direct fixed cost, tracing indirect overhead would be difficult, not practically possible. So you take the possible one, cost base, and then you add a large markup as 150% to cover three components, to cover the direct fixed cost, to cover the indirect overhead, and to cover your net profit. Then you set the selling price. That's why you had a 150% markup. Look at the second one. It is now direct cost pricing. Now you know the direct variable cost, and it is possible to get the direct fixed cost as well. That is your cost base. And then you need to add a markup to cover only two components, indirect overheads and the net profit. Indirect overheads, it's not possible to calculate with the practices. So to cover both, you don't have to add now 150%. Now you can add 70%, and you ended up with the selling price. Look at the third one, full cost plus pricing. Full cost means you know the full cost. It's easy to trace the full cost of a product. Direct variable cost, you know, direct fixed cost also you know, and then indirect overhead also you can calculate. So that becomes the cost base, and then you add 35%, not 150 or 70 or larger percentages. 35% markup, net profit is there. So you ended up having the selling price. So based on the traceability of your organization, you can have these different markups for your products. Now tell me, in your organization, any one of you using cost plus pricing? Cost plus pricing. Any one of you? These methods, cost plus pricing method. Right. Apparently, no. Full cost plus pricing. Okay, good. Full cost plus pricing. So you, what is your industry? What is your company? Tea exporting. Okay, so you can calculate direct variable, direct fixed, and indirect overhead as well. So do you use ratios for indirect overheads like overhead absorption rates? Maybe yes. Because we don't know the exact prices. All these are estimates, budgeted figures. So you use this, you may be using this overhead absorption rates, and then you calculate indirect overhead for one unit, and then you add the profit, that means the net profit markup, standard absorption rate derived from exactly, yes, absorption rate, OAR, overhead absorption rate, and then you come up with the selling price. Thank you. Okay. And then another concept, that is full cost plus pricing. Another concept would be target costing. Target costing means the exact opposite way of, that means a reverse of cost plus pricing. Now, when it comes to cost plus pricing, we identified the cost, we added the markup, and then we set the price. But target costing is something like this. There are 4 stages. You determine the target price that customers will be prepared to pay for the product. You first identify your price. Let's say based on the market leaders, based on the customers' demands, market conditions and all, you set the price first based on the competitors and everything. After a huge analysis, you set the price first, right? And then you deduct a target profit margin from the target price to determine the target cost. It's like this. Now, after doing a comprehensive market analysis, you set your target price. Now, let's say if you are not a price setter, but price taker, I would say, target price would be, let's say, 1,000 rupees. We can't go beyond more than 1,000. That 1,000 would be the price for us. So 1,000 is the price. Then you deduct your target profit margin from the target price to determine the cost. That means now you deduct your target profit margin. That means your company has decided whatever the price we sell our product, you need to have 20% markup. 20% margin, I would say, okay? 20% profit margin. So what would be the 20% profit margin? What is the difference between margin and markup? Nothing. What is the difference between margin and markup? Markup means profit based on the cost. Markup. Margin means profit based on the selling price, right? Profit based on the selling price. So 20% profit margin means from the selling price of 1,000 rupees, 20% would be your profit. Okay, that is 200 rupees. So what should be your cost? What is your target cost? 1,000 is the price, 200 is the expected margin, 800 would be the cost. Your target cost is 800 rupees. Are you clear? So this is a backward calculation, 800 rupees. But now, when in your company, when you analyze your cost structures and everything to manufacture this product, you identify your estimated cost per unit. When you actually see with discuss with your suppliers and all, your estimated cost would be 900. Now, target price is 1,000. When you deduct your target profit, your target cost should be 800. But when you actually go into your company and go into your details, your estimated cost per unit is 900 rupees. Now, what should be done? Now, what should be done? What's the next step? What should be done? Now you should compare your target cost with the estimated cost. That means 800 should be the target, whereas your estimated cost is 900. You need to reduce this cost gap. You need to address this cost gap. That means calculate the budgeted cost. That means this estimated cost, budgeted cost. If the budgeted cost exceeds the target cost, in this situation, your budgeted cost has exceeded the target cost. Investigate ways of driving down the budgeted cost to the target cost. Now you need to find out ways. how to make 900 as 800, how to reduce the cost from 900 to 800. Maybe now you can renegotiate with your suppliers, renegotiate with your laborers, those organizations, renegotiate with or reconsider using a different material, I would say, right? Increasing the efficiency levels, maybe investing in technology. Likewise, you will have to reduce the cost gap. This is target costing method, target costing method. Especially this is important when you are a price taker. When you are a price taker, right? You need to reduce the cost gap and achieve the target cost, the calculated target cost. So this is how you do it. Okay, small activity. NCC company manufactures two brands of computers, simple computers and complex computers. A market research reveals that the similar products to that of CC, that means complex computer, are sold at a market price of 350. That means what is the hint? Similar products are sold at 350,000 in the market. That means can you sell the same product at 500,000 in the market? No. You have to comply with the competition. So NCC estimated the cost of producing CC is 305. Now you have estimated your cost as 305,000 and the company wants a 15% target profit on sales revenue of CC. What is the target cost? Now in that case, if I apply the same thing here, target profit is 15%, no? Right. So I would say the target price would be 350. You can't go beyond 350 and you don't have to go below 350 as well, right? If you can reduce the price with a small gap, but not 200,000. Obviously you can't, right? So I would say 350. That is your target profit. So this should not be exactly 350, right? You can have slight margin, slight differences, but for this calculation, I'm taking 350,000 with the market research. And then target profit is 15%. So I'm calculating 15% from the selling price. That is 52,500. So the target cost would be 350,000 minus 52,500, 297,500. That would be your target cost. But what is your estimated cost of manufacturing this computer? 305. 305. What is the cost gap? What's the cost gap of this? 305 minus 297,500, 7,500. That means you need to reduce the cost gap by 7,500 to achieve the target cost, right? If this cost gap is way high, then that's the problem. If it is a small amount, that's okay actually. But you need to reduce this cost gap by 7,500. That is the cost gap. This one, right? Okay, now I have included this link. This is a very small one, but you can watch this YouTube video. Anyway, yes, I have shared the link, but give me a second. I'm putting this link in the chat box as well. Yeah, this is the link. So you can watch this for target costing. That's an interesting one. And then the last one, introductory pricing policies. Now, there are different pricing policies in an organization. Not in an organization, in theoretically, there are so many pricing policies. Introductory pricing policies means when you introduce a new product in the market, there can be different ways you can price a product. Two more popular pricing strategies would be price skimming policy and penetration pricing policy. What do you mean by price skimming? Price skimming policy. That means at the very beginning, you set a high price, charging higher initial prices. Why? To maximize short-term profitability by spending heavily on advertising and sales promotions to obtain sales. when demand is not very sensitive to price changes. So at the very beginning, you set a high price skimming, and then you need to maximize your short-term profitability. That is the organization's goal, short-term profitability. Once the market becomes saturated, that means after some time, when the market becomes saturated, the prices can be reduced to attract that part of the market that has not yet been exploited. You set a higher price, so you won't have many customers, I would say, in that situation because your prices are higher, but there will be premium consumers for that. For your premium product, there will be premium consumers. There will be customers. But by selling your product at a higher price, you try to maximize your short-term profitability. Now, after some time, now the product is very popular or the product is known in the market. Even though customers are not purchasing, product is very known as a premium product, you slowly reduce the prices. Then that potential customers will try to buy because the prices are reduced. Price skimming policy. Look at the other way around. Penetration pricing. That means policy of charging lower prices initially to obtain sufficient penetration into the market. That objective is to go to the market as much as possible, to have a broad market share from the very beginning. Use at a very low price so it will penetrate. You will have sufficient penetration in the market, so there will be more customers, but your price would be lower. Price is lower, but quantity would be higher because of the prices is lower. Market price skimming one, quantity would be less, but price is high, so you can maximize your short-term profitability. Both are good. Companies are using these. So pricing policies may vary depending on the different stages. So these are introductory. When you introduce a product, these two pricing policies can be used. Right. And then pricing reviews, as I mentioned earlier, whatever the prices you set, let's say when you introduce a new product or when you have an existing product, you already have a price, it's really important to review the prices. Really, really important because we are living in a dynamic environment, especially in Sri Lanka. Things are changing very fast. Now you need to review the prices. That means comparison of actual sales with the previous year's sales and budgeted sales. Now, to review the prices, definitely you need to see whether estimated sales quantities are getting achieved. What is the budgeted sales quantity last year? But what is the actual sales quantity last year? If there's a huge gap, maybe you will have to reconsider your prices because maybe your price is expensive in the market. That's why consumers are not purchasing, right? So you need to compare the results. Maybe market share in individual markets. That means you need to identify, you need to consider the market share. If you want to if you want to get a good market share, a higher market share, maybe you will have to reduce the prices. Previously, it was 100 rupees. Now you are slightly dropping into 90 something, right? So you can expand your market share in that case. And then price complaints. If there are complaints coming from the consumer saying that this is very expensive, this is not worthy, then you will have to consider, you will have to review your prices. Competitors' prices. Earlier, it was 100 rupees for your product and competitors were also having 100 rupees. 101, 105, 95 likewise. But now, when you look at competitors' prices, they have set the prices as 80. Now, can you say the same product 400 rupees? No, you can't. So again, you need to review the prices and do the necessary changes. So that is why pricing reviews are very, very important. And also remember, when you review the prices, you can't, you can't actually, you can, but there will be significant impacts coming from the market if you just increase your prices by 50% or 70% or something like that, right? If it is not a very common commodity, essential commodity, based on the price elasticity, there will be repercussions. So if it is abundance, you have to be careful. You can't increase the price by 100%, right? At once, there will be repercussions on the demand. So likewise, making all these points, you need to anyway review the price and slowly change the prices you have. Right. So these are the pricing reviews. And with that, yeah, it's 11:06 as well. Today we are finishing early, I would say. Okay. So with that, we have come to the end of today's lesson. We have covered CVP analysis as well as pricing decisions. Do you have any issues? Okay. Yeah. What are the price? Oh, I will check that link then. It was all fine. Yes, I will check that. All right. So today actually I'm ending early because I have covered everything to be discussed, and last 4 weeks actually we exceeded the time, no? But thank you very much for bearing with us with the guest lectures coming, and they took much time, right? We went till 11, no, 12 or more than 12. So thank you very much. If you have any issues, you can ask. And if you are not added to a WhatsApp group, still like you can ask Miss Shanti or Miss Kaushalya from CMA because you are getting those emails, no? You can ask them to add you, right? And then of course, I will be giving you the last week, next week, I will be, oh, okay. So I will be giving you the assignment you have to do. There's a small assignment, no? But I will explain that assignment in detail next week because anyway, that is okay. You have time for that. So I will explain the assignment next week. It's a very small assignment, I would say. Okay, so thank you. With that, have a great weekend and let's see you next week. Thank you very much.